Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of discussion is how to set up a trust to protect your wealth and minimize your estate taxes. So talking about the topic, first of all, we will discuss that what is a trust basically, what is the definition of a trust and why would I need one. So, you are likely familiar with essential estate planning documents like a will or a power of attorney, but you may not have thought much about another valuable financial vehicle, a trust. At its most basic, a trust is simply a legal entity that can own assets like investment or property, a container of sorts. Adding a trust to your estate plan can help protect your assets in case you are incapacitated. So, and ease the process of distributing what you own to your loved ones after you die. Essentially, a trust is a more efficient estate planning vehicle than a will alone. So, says Jason Albano, managing director and wealth strategies executive at Bank of America. While trusts are not just for wealthy, the wide variety of them and their seeming tricky rules can make them feel intimidating. So, how our trust works: you, the grantor, establish the trust, transfer assets to it, and pick a trustee or our trustees to manage the assets and the name of name beneficiaries to receive the benefits. As the grantor or the creator of the trust, you can also serve as the trustee. With the trust, you can provide specific instructions for when and how the assets should be distributed and used by the beneficiary. So here's what else you need to know so you can decide whether a trust should be part of your plan. So what are the main types of the trust go by several different names and serve various purposes, but one of the key distinctions is whether the trust is recoverable or irrecoverable. So talking about the recoverable trust, when you transfer assets to a recoverable trust, also known as a living trust, you remain the owner of the assets during your lifetime and can use them as you wish. So, and you can also amend or dissolve the trust at any time. At your death, the trust generally become irrecoverable and the trustee distributes the assets to your beneficiaries based on the term you laid out. A recoverable trust is a simple and effective way to transfer wealth, says Albano. Then comes the irrecoverable trust. When you establish an irrecoverable trust, you permanently relinquish control of the assets and remove them from your estate, which can offer protection from the creditor's lawsuit and divorcing spouse, as well as potential tax benefits. People typically use irrecoverable trust for legacy planning and to transfer wealth to multiple generation. Albano says so. What are the basic benefits of our trust? Talking about the benefits of a trust offers a variety of benefits both during your lifetime and after your death, such as these. The first benefit is peace of mind in an emergency. So if you have moved your assets into a trust and become incapacitated, and a trustee or the success or your successor can step in to manage them, your trust document should spell out who should act as trustee if you can't, and how your trust should be used for your benefit. So then comes the greater control. A trust allows you to have a more precise say in what happens to your assets than a will does. That might mean setting parameters such as ages when children can receive the funds. A trust can also provide ongoing money management instructions, some time to consider if your loved ones will not be interested in or capable of that. The third point is faster settlement of your estate. You will must be authenticated in probate court, which can hold up the process for months. Assets in a trust avoid probate, allowing your loved ones to receive them more quickly. Also, a will is a public document. The term of a trust remains private. Then comes the estate tax savings. Transferring assets to an irrecoverable trust removes those assets from your estate, potentially reducing future estate taxes. Then comes security for a loved one with disabilities. When you have a family member with special healthcare needs, you can use a type of trust called special needs trust to support them financially after you die without endangering their eligibility for the government benefits. So the sixth benefit is simpler property transfer. If you own real estate in more than one state, your hires will have to go through the probate in each state. Probate can be costly, time consuming, and complex when multiple homes are involved. So, Albano says if a trust owns those properties, the transfer of the ownership is seamless. So, what assets can you put in a trust? So if we talk about that, what assets you can put in your trust, you can transfer ownership of investment accounts, your personal residence, commercial real estate, a business, a family limited partnership, or other high value property to a trust. Typically you don't put designated retirement accounts in a trust, since when you die those assets easily pass to the beneficiaries you have named. So you can also keep checking and saving accounts outside of a trust, so that a trusted person can quickly access the cash to pay immediate bills such as funerals costs and the financial medical bills. To make that possible, complete a transfer on that document for the account. So then comes why do you need a will if you have a trust? So, talking about this point, even when you include a trust in your estate plan, you should still have a will. A will names that executor who will get access to your savings after your death to pay your bills and distribute personal property that's not in the trust, such as a car, a sentimental, or a household item. With minor children, you need a will to name guardian. So what's involved in setting up a trust? So if we talk about setting up a trust, that what is involved in it, you can discuss whether a trust is suitable for you with a financial advisor or an estate lawyer. So but if you can decide to set up a trust, you will have to hire a trust and estate attorney to draft the trust document or use an online legal service. In addition to initial legal fees, you may face ongoing expenses, especially with an irrecoverable trust, such as administrative, asset management, and tax preparation fees. So, who should consider creating a trust? Setting up a trust takes time and money. You will want to make sure the benefits to you and your loved ones justify the expense and the work. One consideration is the value of your assets outside of your retirement accounts, but a trust may make seen at any level of wealth. Your goals and situations should be deciding factors. Albano says anyone who's concerned about transferring their wealth has property in multiple jurisdictions or want to put protection in place for the people inheriting the wealth should consider a trust. So more talking about that, how to avoid estate taxes with our trust. So estate taxes are basically a form of transfer tax that affect the very wealthy. For multi-millionaire household, avoiding the estate tax is a significant issue. One tool that households can use to try to minimize their estate tax liability is the trust. However, it is important to understand that This is not a limited, this is a limited and fairly specific tool. Here's what you need to know. For help with your estate plan, consider working with a financial advisor with estate planning expertise. So the next step, trust and estate planning can be overwhelming. We recommend speaking with a financial advisor. This tool will match you with up to 3 advisors. Here's how it works. Answer these few questions so we can find a match. Our tool matches you with vetted fiduciary and advisors, so who can help you on the path towards achieving your financial goals. It only takes few minutes. Check out the advisor's profile, have an introductory call on the phone or introduction in person, so and choose who to work with in future. So what is the estate tax? Talking about the estate tax is a transfer tax like income or capital gains tax. So it triggers when someone receives wealth or assets that they didn't have before. In this case, the estate tax triggers when someone receives assets from a deceased benefactor. The estate tax only applies to estate worth more than the IRS capital, and the IRS adjusts this capital each year to account for inflation. In 2025, the estate tax only applies to estates worth more than $13.99 million for individual and the $27.98 million for married couples. This is an increase from 2024 when the lifetime exemption was worth $13.61 million for the individual and $27.22 million for the married couple. So as with all the tax brackets, the estate tax applies only to the assets above the capital. For example, on an estate worth $15 million, the IRS would only collect taxes on $1.01 million for the 2025 tax year. So this is an important distinction, and one that people often get wrong. Similar to income taxes, assets above the estate tax capital have no impact on the assets below the capital. If your estate is worth $13 million, you will pay no estate tax. If your estate is worth $20 million, you will pay no taxes on the first $13.99 million. So the only question is whether your estate pays taxes on the assets above the capital. The major difference between estate tax and the most transfer taxes is that it is borne by the payer, not the recipient. If you die and leave a multi-million-dollar estate to your heirs, the estate itself would pay any taxes owed to the IRS. Your heirs would then receive the remaining post-tax assets. Estate tax rates are comparable to income taxes with brackets, then scale from 18% at the lowest to 40% are the highest. So revocable trust cannot avoid estate taxes. So if we talk about as a threshold matter, one of the most common forms of our trust is the revocable trust or revocable or living trust. So this is the third party trust that you set up during your lifetime or which you maintain control over. So you can move assets in and out of the trust, oversee it investments, and the change its beneficiaries and more. There are many users for a revocable trust, particularly when it comes to helping your estate avoid probate issues. Estate tax relief is not one of them. Under ordinary circumstances, passing your assets through a revocable trust will not shield them from the estate taxes in any way. So what are irrecoverable trust? Can remove assets from your estate. So the second most common form of trust is known as irrevocable trust. So as its name suggests, when you make an irrevocable trust, you sign over control of the included assets. You name who will benefit from the trust, how it assets will be managed and distributed, and the what assets you initially are including. Then you are then free to contribute additional assets over time. However, once you establish the trust, you cannot change its term without a court order. You also cannot withdraw or directly access the assets you have contributed to it. The downside to this is that you lost direct control over your assets. You can name yourself as a beneficiary, which allows you to receive and use anything based on the terms of a trust. But this is not the same thing as owning those assets directly. The advantage of this is that you remove these assets from your estate once you put something in an irrevocable trust. It legally belongs to the trust, not you. Assets in an irrevocable trust do not contribute to the overall value of your estate, which for a particularly large estate can shield those assets from potential estate taxes. But that doesn't mean the assets in an irrevocable trust are shielded from taxes altogether. Instead, the assets in an irrevocable trust are taxed at different rates depending on their status. So in most cases, this means either the trust itself pays income on undistributed gains, or the trust beneficiary pays income on money they receive from that trust. So, residence trust can shield real property. A residence trust is another form of irrevocable trust, because only irrevocable trust can shield assets from estate taxes. Here you put property such as a home into the trust's name. You then list yourself and your heirs as the beneficiaries of the trust, allowing you to continue using the house and letting them do so after you die. The result is that the trust owns the property, but you and your heirs can use it. The advantage here is that there is no asset to tax. Even though you and your heirs can continue living in the home, you don't own it, so it can't contribute to your estate for tax purposes. This is particularly useful for people who are house rich. So what are the intentionally defective grantor trust? Finally, one of the most popular form of trust for estate tax planning is known as intentionally defective grantor trust. One of the biggest downsides to the transferring assets through an irrevocable trust is that it still involves some degree of the tax liability. Even though you shield those assets from estate taxes, your heirs or the trust itself will still pay taxes. So typically, is one of this comes in the form of income taxes, which either which either the trust pays on your higher pay when they receive distributions. You can mitigate that through the use of an intentionally defective grantor trust, or the IDGT. This is an irrevocable trust into which you place assets, again shielding them from estate taxes. However, you maintain responsibility for paying taxes on the trust assets. This allows the trust to grow tax free over time since you pay its taxes. So if we talk about the bottom line, for every high net worth household, estate planning will involve some taxes. By using trust, you can structure your way out of and around some of that liabilities. By setting up a trust to hold various assets, you can potentially reduce your overall estate tax liability. Trust can work under the right circumstances and for the right assets, but they require a lot of planning. So what are the tips for planning your estate to maximize the legacy you leave to your heirs? Consider having a professional put together a comprehensive financial plan and investing strategy for you. So a financial advisor can help you with both. Finding a financial advisor doesn't have to be hard. A smart assets free tool matches you with a to 3 vetted financial advisors who serve your area, and you can have a free introductory call with your advisor matches to decide which one feel is right for you. So if you are ready to find an advisor who can help you, so you can get start now. Hope this will be beneficial for you. So do subscribe the channel for more informational videos in future. Thank you so much.